Welcome back to the channel, guys. Sorry it took me a while to get this one out. It was slightly more detailed in terms of the strategy, but what we're going to cover today is the MSTY European ETC from HANetf and YieldMax. We're going to go into a little bit around the structure, the strategy, and potentially the risks as well. So we're going to start off with just an overview. So the headline distribution rate for the fund is 45.57%, is the distribution yield based on the latest distribution. So MSTY aims to generate income from MicroStrategy, MSTR's volatility, and we're going to look at how it achieves that. In terms of the issuers, so as I said, the issuers is HANetf. So HANetf was founded in 2017. It's a European white label ETP platform with circa 7.7 billion of assets under management. They partner with asset managers to handle regulatory and operational work required to launch their strategies in Europe. And then we've got YieldMax, which probably a majority of people watching this have probably heard of them now, are a US-based ETF issuer who first launched their funds in 2022, which is crazy to think. They specialize in high income option strategies on single stocks and manage circa 17.5 billion in asset management across all their funds. So again, the issuer and the people running the actual trades are both very large fund providers. If we start to look at the structure now, and it's a bit of an unusual one, and this is why it took me a little while to pull all this together, because it's not like the standard one we're used to seeing where either the ETF or ETP or the ETC is directly owning the underlying, or it's a case of it's running a synthetic position. This is a bit unique in the sense that when you buy this particular ETC, let's say on a European exchange like the London Stock Exchange, it's wrapping up MSTY, which is the YieldMax MSTY fund in the US. And then the US MSTY ETF, the engine, if you like, is the one that's actually got the covered call strategy on MicroStrategy and holds the treasuries as collateral. Just to repeat that again, when you buy the MSTY fund ETC on the European exchanges, that is a wrapper for the MSTY fund in the US, which is the one that actually runs the option strategy. So a bit confusing there in terms of the structure. It's not as the standard one that we're used to seeing. So again, another thing to bear in mind that this is an ETC and not an ETP, which we're used to seeing, and it's not a traditional UCITS ETF. Predominantly the reason why that is, UCITS has certain rules that require diversification, which a product focused on a single stock like MSTR is difficult to meet. And the list leads to key differences in kind of the risk and the regulatory side of things. So from an MSTY ETC, which is this product we're talking about, it's got a debt security. It's not UCITS compliant. It doesn't have to have diversification rules, so it can concentrate on a single stock. It does have credit risk with the underlier, but as we've just talked about, HANetf is a very large white label provider, so I think the risk is very low there, but it's worth calling out. And then the tax treatment, again, because it doesn't have that same advantage being in Jersey and there is no agreement on the withholding tax, it does have a 30% currently withholding tax. They are trying to find ways around that to get it down to 15% or less, but currently it's 30% withholding tax. Traditional UCITS funds, they must be compliant. There are some strict rules around concentration. The primary risk is just market risk. There is no credit risk there. And the tax treatment is typically more advantageous. And at the moment it's 15% or 0%. Another thing that's quite unique with this fund is how the ETC fee is collected. And so what they're doing is when you buy one share of the European MSTY, you're entitled to the value of approximately 1.5 shares of the underlying US MSTY ETF. So this is your ratio of your entitlement. But how the fee is taken is, instead of charging you a fee for the account, the ETC issuers slightly reducing the entitlement ratio every single day. So this daily reduction is how the 0.59% annual ETC fee is collected. And I've done a chart of this kind of reflection on the right-hand side. They've done it in table format on their website. I'm a bit more visual, so I've tried to represent it in a chart, just so you can see that as it goes down, and you can see the numbers here on the left-hand side. So what does this mean for you, the risk side of this? So yes, there is a risk. It means over time, each of your European shares is buyed back by progressively fewer US shares. It's almost like a guaranteed predictable drag on your investment, separate from any other market movements. So your holding is constantly being diluted by paying the fees. But it is another way of just simply taking the fees out of the fund. It's a bit of an unusual one. I've not seen this being done elsewhere. And I think that's why I wanted to call it out, because I don't think it's stuff that investors would naturally understand when you're buying into this type of fund, because it isn't what I would call typical. Maybe we can get a view off Hector or HANetf or someone from YieldMax to explain this idea and maybe the advantages for the investor and maybe for them. It'd probably be good to get some understanding on that. Let us know in the comments, by the way, whether we should reach out to Hector and get some understanding of this, because I'd be curious myself, I think. When we talk about this annual cost, that is 1.58%. And according to the KIID document, that's the 0.59% ETC fee applied with the daily entitlement that I showed above. And then there is the obvious fee of the fund in the US itself of 0.99. So there is a 1.58% total annual cost to owning this. So again, just something to be mindful of, that you've got that double fee to think about. Let's start to look at the structure now a little bit and the underlying. So as I said, this is a synthetic strategy. So the US MSTY ETF doesn't own MSTR stock directly. It uses derivatives for capital efficiency, freeing up the assets to be held in low risk US treasuries, which are the collateral. So what's the advantage of running a synthetic MSTR position? The fund basically mimics owning MSTR stock by buying MSTR call options and simultaneously selling MSTR long put options. This replicates the stock's price movements without having a very large capital outlay of owning the shares. So again, it's very capital efficient for that reason. The fund then sells short-term, weekly, monthly call options against its synthetic MSTR position. These options are normally out of the money, which caps the potential upside, but obviously in exchange for that, they get the immediate cash income known as the premium. The premiums are then collected from selling the call options, and they're the primary source of those high monthly distributions. The process is basically harvesting the volatility within MSTR, and then it's a rinse and repeat strategy. Just to understand a little bit around MicroStrategy itself. So it started off as a software business. It was originally a business that provided enterprise analytics, business intelligence, that kind of generated a modest revenue. It then turned into a leveraged Bitcoin proxy. So its primary identity now is a Bitcoin treasury company, and it aggressively uses debt to acquire Bitcoin, making it one of the largest corporate holders of a highly volatile proxy in the form of crypto prices. Now, I've done a whole separate video on the MSTR. I'd recommend you go and watch that after this, just to get a bit more understanding around MicroStrategy itself and how it's made that transition. If we now look at, in terms of the actual performance, now, obviously the MSTY European fund has not been around for very long, a couple of months, but we've obviously got the data from the underlying, in this case, the MSTY YieldMax US fund. So this is the numbers that I'm sharing today. I've taken the numbers from 22nd of February, 2024 to July 18th, 2025. And we can see the returns have been incredible. This is including dividends reinvested, by the way. So it's over 300%, which is just ridiculous. But what's even more insane is the MSTR, the underlying itself, is almost done 500%. So again, we can see that cap upside, right? Which is what cover calls are all about. You're taking that trade off the table of the full growth potential for that income. And you can see that you are sacrificing a fair amount of that upside, almost around 80%, Todd. But what you are benefiting also is that when there is a drawdown, and we can see during that same time period, MSTR had a drawdown of around 50%, whereas MSTY only had a drawdown of 40%, so almost 9% less. And the reason for that is obviously having those extra premiums to offset that drawdown. So there are some positives here in that sense that yes, you are capped on the upside. You do get the full downside, but you also have some of that protection with the premiums when we are going on the downside. So again, it's about understanding how these cover call strategies behave in different market conditions, whether it be bullish market conditions, sideways market conditions, and in downward trending conditions. In terms of the capital risk and the return of capital and the NAV erosion, obviously these are high yields, are often misunderstood, right? And sometimes a proportion of your capital is a return of capital. Now we need to be a little bit careful with ROC. Now ROC can sometimes be genuine ROC, which is genuine return of capital, and sometimes it can be a tax treatment. The strategy gains are capped on the upside, but it captures most of the downside. And so over time, this makes it hard to grow the value of the fund. The higher distributions, the funds pay out those large distributions from the options premiums, and this can impact the fund's NAV. The payout is classified as ROC. You get the cash, but the value of your remaining investment in the NAV permanently decreases. Now, we've got to be careful, as I said, with return of capital. It can sometimes be just simply a transfer of capital. So it could be a situation of the NAV was 50, they paid out 5, the NAV drops to 45, but you're holding the 5. So the net is still the 45 plus the 5 is still the 50. There are times when there is genuine return of capital, and that's when the NAV does erode and you don't recover. Now, another thing to bear in mind when we talk about return of capital, the reason why they're able to classify a return of capital from a tax perspective is because they might lose on the trade itself. But that doesn't mean they've not made the income from the premiums. So again, it's just about understanding the different dynamics of this and understanding true return of capital. Let's move on to start to look at the risks now and the conclusion of this. So according to the KIID, the Key Investor Information Document, the summary risk indicator for this product is 7. That's not unusual for these types of products. Obviously, they're taking that single stock risk. You've obviously got the Bitcoin proxy play. So again, these are going to be higher risk investments. The recommended holding period is 5 years in the document. So again, this is another thing that I've noticed in the community and generally with these high yielding plays. People seem to YOLO out of them very quickly in a short space of time, and you really need to give them time to do their thing in terms of because they take all the downside and they're capped on the upside, the recovery can be quite slow from a share price perspective. And I think a lot of investors still are not always looking at total returns and putting the two together. I almost blame brokers a little bit here, because the brokers show you your unrealized gains or losses, but they don't show you that offset with the distributions that you've received. I actually run a dashboard where you can put all the numbers in and it will tell you whether you are positive from total return perspective, what your payback period is. So I'd highly recommend that you sign up for that so you can get a proper visibility. There's also Snowball Analytics, which is again another good tracker out there to be able to do these kinds of things. But I'd encourage people to just be mindful that these products are not designed to be products that you just buy in and then you sell out very quickly. You have got a reasonable time horizon of at least 1 to 5 years to be holding these. Obviously, this being an ETC, as we talked earlier, it isn't UCITS compliant. So there's some things you need to bear in mind with this. But the good thing is you're able to hold this within a tax wrapper in the UK. So you're able to hold it in an ISA or a SIPP. So there are some real big advantages there of doing that. but obviously you do need to offset that with some of the tax treatments and things like that. But again, speak to a tax advisor, figure out what makes sense for your own personal circumstances. So expanding on the risk reward profile here, obviously the biggest reward is obviously that high income potential, right? The ability to get the highest cash distributions, get the monthly cash flow, getting a regular cash flow, even though it may be slightly sporadic depending on the volatility, but you are monetizing that volatility directly from the underlying MSTR stock. What are the risks? You've got that potential NAV erosion, the return of capital, understanding true total return, the capped upside, right? We saw how this MSTY US fund was not outperforming MSTR, but we need to also understand when there are swings in the share price. 1 week, these are quite volatile. They could drop by 10%. The following, we get the full downside, obviously offset with the premiums. But then obviously the next month it could go, or the next week, it could even swing back up 10%, go for our strike price, and we've lost that capture of the rest of that upside. So again, it's just bearing that in mind. Obviously, we talked about the full downside exposure plus the cushioning of the premiums. There's obviously that single stock risk with this particular single MSTY ETF and the single stock underlying. I was questioning whether to put the Bitcoin risk in there because obviously, yes, this is a leverage play on Bitcoin, and then everyone's view on Bitcoin is different. Some people say Bitcoin isn't as risky as some describe it as. I'm going to go off what the market treats Bitcoin as, which is a speculative play, an investment play. So I put it in the risk category, but I can understand why people could argue the case either way on that one. And then very lastly, the issuer's credit risk. Now, again, we looked at how large HANetf was. We've had a lot of engagement from the CEO, Hector, in answering our questions and their transparency. Although I'm putting it in here because it's the right place to put it, it's very minimal in my view, but it's something to bear in mind still. So just for summary and conclusion now, MSTY is engineered to do one thing, which is convert the extreme volatility of MSTR stock into a highly monthly cash distribution machine. However, this comes with that unavoidable cost of the capping of the upside. So you're going to get that high monthly payout, the capping on the capital growth. And my kind of final verdict on this is that obviously MSTY is speculative, it's tactical. You need to decide, is it going to become a core part of your long-term holding, or are you going to use it as a play to be able to capture some of that income and then fuel that part of that growth part of your portfolio? I would argue that this is probably for investors that have a bit more of a higher risk tolerance. They understand the NAV erosion. They understand that they're giving up growth for capital income. And so I just want people to think through when they invest in these types of funds to understand what ultimately works for them. Obviously, everyone's got their own view on this type of fund. Again, all I ask is you do your own financial research. This was just for informational purposes only. Hopefully you enjoyed it. Let me know whether you like the new dark theme versus the light theme, and also whether you like the new tab structure. Let me know in the comments. And also let me know whether you are investing in this fund, whether you like the structure, whether you like MSTR as a company. Just let me know in the comments, guys. Thanks a lot. I will catch you on the next one.